In this video, we're going to talk about Senseonics, trading under the ticker symbol SENS. Right now, there's lots of volatilities coming out of the financial market, and we have to be careful about which stocks to buy, to sell, or to stand aside. This video is going to cover the recent price action momentums and the technicals of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed, and that it may not reflect all the latest events. If that is the case, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock increased to $1.86 before closing the trading day at around $1.85. We should pay attention to the $2.11 nearby because it was tested 2 times before as a support, and now it can be a potential resistance that the stock has to go through in order to confirm a reversal of the recent selling pressure. Over the past 30 days, the trend of the stock has been recovering, although slowly, from a massive bearish pressure, because the stock lost nearly 50% of its value within a couple of weeks, before the current price level that seems to be a bottom for once. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock has been trending within a range, because the cycle has been fairly long and has been going on for the past 24 months. For the moment, despite the short-term selling pressure, I believe that as long as we can find a good support somewhere down in the penny stock levels, it is still too early to say that the stock is in a downtrend. It's going to be a hard few months ahead of us, but at the same time, there may be some light at the end of the tunnel if the entry point is sufficiently low. With that being said, it's safe to say that the downward pressure is still very present in the stock, and we have to keep in mind of this fact going forward. When we look at the price trend overall, it's been accelerating because the stock was simply testing the support levels and trending mildly into the bullish territories for a month, and the dip was very recent and sudden. The trading volume of Senseonics has been recently around 24 million shares versus the average of around 21 million shares. Over the previous 52-week period, its price fluctuated between $1.40 and $4.58. The market cap of Senseonics is currently at around $713 million versus the enterprise value of $1.9 billion. The difference between the market cap and the enterprise value is in the premium or discount the financial market is willing to allocate to the company based on the company's current fundamentals, leverage, real-world events, and asset composition. The enterprise value is the combined value of the company's assets minus all the debts. If the company has a lot of debt or has a negative image amongst market participants, the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient for many other companies. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is called goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than other companies, partially because it has a better management team, a stronger brand recognition, a bigger online following, and so on. It is what makes this company unique versus other rivals. In other words, it may not be a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, as the market cap is lower than the enterprise value, especially in very volatile and negative situations for the company. But in the scenario of a liquidation, the goodwill is no more, and the shareholders and bondholders will be left with whatever that is left on the balance sheet. When we compare the current price to its historical price fluctuations, the stock is 30% higher than the 1-month low, 30% higher than the 3-month low, and 30% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to head toward, the implied volatility is 133% versus a historical volatility of 155%. The put-call volume ratio is currently at 0.36. It is normal for most stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 17,000 contracts a day versus the 30-day average of 23,000. In terms of open interest, the most recent volume of open interest has been 384,000 contracts versus the 30-day average of 375,000 contracts. Regarding the shareholder structure, institutional shareholders own about 30% of the outstanding shares, and the biggest ones are BlackRock, Vanguard, and State Street. It's relevant to understand the shareholder composition of a company because it helps to determine if you should hold the stock long term or to view it as a trade opportunity. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subjected to a lot of exceptions since many titles are mostly held by retail investors and not institutional ones, but this is the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are a significant short interest in the total volume, this can be a sign that there's an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 25% of the total float and 37% coming from the dark pool. Overall, my opinion on Senseonics is to keep the company on your watch list because it is known to be a volatile stock and right now it is testing levels that have been the floor since 2019. The stock is currently in a clear downward spiral and it may take a while before the stock finds some support. We have to watch closely the $1.40 level because if the stock maintains itself above the price for 1 or 2 weeks, then this can be a sign that the stock is going to reverse from there. If it doesn't manage to hold on the line, we're looking to the penny stock levels. The maximum exposure I would recommend in the scenario of a buy is 1% of your portfolio. For the immediate term, my recommendation is to wait for better timing because we have to see some more confirmations that the support levels can be held before going further. I would recommend to separate the allocation in batches of 10% at a time so that you can have enough room for purchase later. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors, With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.